Hello and welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
And so I was downtrodden yesterday after Microsoft. I would not buy the stock, even on this dip. I've owned the stock for a long time. I'm not selling it either.
We expect that the economy grows 2.5% this year. That's above consensus, is above what the Fed anticipates. But it's mostly just a continuation of what we've seen over the past year. The economy grew essentially 2.5% in 2024, so we expect that to continue. Now, obviously, there's a lot of moving pieces and a lot of uncertainty around that. This weekend, we could get tariffs on Canada and Mexico that are 25%. We could get an across-the-board tariff that has been talked about by the Trump administration as well. Those are not in our forecast as of yet, but that would tend to dent growth, but also lift inflationary pressures this year.
This is a real tragedy. You start with the air traffic control system and airspace is very safe. It's safer than it has ever been, despite this tragedy. And our priorities and objectives remain the same. Fund the FAA modernization, fund our air traffic control system and staff our controllers. And we need to modernize the system.
We've got 1 hour to go until the market close. So let's take a look at the major averages here. We have got a rally going on. And at first place, I just want to make an observation, which is like the Fed meeting seems very far in the rear view mirror, right? In other words, Jay Powell, Fed chair, who did his press conference yesterday, the Fed did not change rates, didn't want to rock the boat, didn't want to upset the markets. And it seems like day two, sometimes on day two, you get like a snapback, you get continuation reaction. Didn't really seem to happen today.
Well, we did get some data today, U.S. economy. Yes. We found 2.5% in 2024, solid, perfectly respectable, Julie. Consumer hanging in there, resilient.
Yes.
So now investors are looking, okay, so what's ahead? How does this evolve in 2025, especially with all the Trump policies we talking about, tariffs, deportations, and we have an economist coming on shortly to help us walk through that.
So all of that said, stocks, pretty much at the highs of the session. The Dow up 0.6%, 287 points. The S&P up about 0.7%, and the Nasdaq up about 0.5%. Now the Nasdaq's been a little bit more volatile over the course of the day, and of course we've got the push-pull of some very big earnings that we've been talking about. We have Microsoft on the one hand disappointing with its Azure revenue. Those shares down 6%. Going to keep on spending on AI data centers. Its AI numbers, specific numbers, actually looked pretty good in the eyes of analysts. And then on the flip side, you've got both Meta and Tesla, but looking at Meta first, up 2% after its numbers.
Yeah, this divergence in the Mag 7, something our colleague Josh Schaefer has been talking about. And he's right, because you just have these different stories. I think Meta, there was kind of something that report for bulls and bears, Julie. You had this kind of, kind of push and pull there, and you sort of see that in the shares. I did think it was interesting that Zuck would talk enthusiastically still about all that AI infrastructure investment despite DeepSeek. And you're right, I mean, Microsoft is getting hit hard today. That is Azure shortfall catching up.
Yes, and then you got Tesla, which the report wasn't great, but a lot of rhetoric about the sort of cyber cab coming, about a Model 2 coming, or a cheaper model. It's all about the vision. That's what we're trading on. And then just a very quick look back at some of our trending tickers, because they include the ones that we've just been talking about. But it is a big, big day for earnings. This is one of the busiest days for earnings that we have gotten thus far. So you had Microsoft, but you also have UPS down 15% on its numbers. You got IBM helping lead the S&P higher, up 12%. Its AI numbers, investors happy about that. ServiceNow, on the flip side, down 12%. So really, the AI story is not a monolithic story when it comes to these earnings reports and the reactions that we're seeing to them. So it's interesting to see it playing out.
Interesting. We have just the guy to help us sort through it. We really do. Stocks are trading higher this session after a barrage of earnings reports Julie was just mentioning, particularly in tech. We have Meta and Tesla higher after earnings. On the other hand, Microsoft is a laggard after cloud revenue fell short of expectations in the second quarter. And everywhere you look, Wall Street is tracking big tech spending on AI. So let's dig into the sector with Matt Miskin, co-chief investment strategist at John Hancock Investment Management. Matt, it's great to see you. Let's start with big tech. We had some big names after the bell yesterday, Matt. You got some big ones after the close today. Apple is on deck. Your thoughts on big tech, Matt? What have you seen so far? Do you like big tech here?
We still like it, and the earnings are coming in at 20% growth year over year, and they're looked at poorly. To us right now, you're seeing a market rotation, and really that is the name of the game. It's less about earnings, it's more about macro, frankly. Chinese stocks are up about 3%. European equities are ripping right now, and you're just seeing money get pulled out of the technology sector and redeployed all over global markets. Will this last? It's hard to say. We think it's really tracing a bit of a acceleration of the economy. But that looks like a mini cycle to us. We don't want to be too tactical, too cute with it. We want to stick with high quality companies with good earnings. That's keeping us with some tech exposure.
Matt, what do you mean by mini cycle? And why do you think that is sort of what this is, the numbers right now are reflecting?
So we're seeing the manufacturing side of the global economy reaccelerate. And maybe it's partially because the Fed did just cut interest rates. That's helping economic activity reaccelerate. But also it may be just more pro-business policy from the administration, pull through demand to get ahead of the tariffs. We're seeing a lot of manufacturing, industrial, CapEx type businesses see this pull through. But whether or not that's really sustainable, usually this is happening out of a recession where you've had an economic collapse and then a recovery. Now you're just getting this kind of sine wave, little bit of a pickup. But we think that's going to be more modest because the Fed's not going to be cutting more. We're still going to likely see a bit slower growth. And so it's not a restart of the cycle, just a kind of mid-cycle retuning. We think that fades into the back half.
Matt, you mentioned the Fed there. What did you make of the decision we got? You know, they telegraphed the pause. You got the pause. In the presser, Matt, you saw Powell, responding to a reporter, did say, yes, I think we're restrictive. Maybe we're not as restrictive as we used to be, but we're restrictive here. Is that to you a sign that, okay, easing bias still intact?
So the Fed's statement was hawkish, and you saw equities start to unravel. You started to see them wobble a bit. And then Powell comes up and just soothes the market. And really then you see equities rally again. You start to see lower quality parts of the market rip. Bitcoin really started to charge higher. And this is what is a challenge as it relates to the Federal Reserve. If they give the market even an inch or risk assets an inch, they take a foot. And so, they've got to be careful here because they're not really being overly hawkish in their communication, even though their written communication is. But to me, it's hard to blame Powell for this in terms of being restrictive. Actually, I think he's been presenting more dovish case, being less restrictive than the markets think. Because if you look at high yield spreads, crypto, equities at all-time highs, it doesn't look overly restrictive from our standpoint.
Matt, let's get back to what you said about wanting high quality right now, not being too cute in this market. I know, while you say you don't dislike tech, I know there are two groups that you like a little more maybe right now, and that's healthcare and industrials. What is saying to you right now that this is a good time for those sectors?
So it's a little bit of the dogs of the Dow type theory of things that didn't do well last year, but there's some dogs of the Dow that frankly are dogs. These sectors actually have really good fundamentals. Healthcare and industrials have improving earnings estimates into 2025. Analysts are forecasting about 20% earnings growth from each. They have had a year off in terms of leadership, and they are starting to come back. So as the market kind of moves away from those mega cap tech names, and it's not uniform, and it moves its way into other sectors, we want to make sure they've got the fundamentals as well. Those two sectors are cheap, high quality, and set for a nice earnings story into 2025.
Matt, what if I told you the Senate confirms RFK Jr. as head of HHS? Would that change your opinion about healthcare, or at least certain verticals or subsectors within healthcare?
We looked at the healthcare sector over time, and actually what we've seen is that the first year after a Republican administration has typically seen healthcare outperform the market. What you see is healthcare usually prices in the worst case scenario as it relates to an incoming administration. And usually the outcome is it's more watered down than what the market had originally priced in. So there's a lot of bad news in healthcare. It was one of the worst performers last year. It really took it on the chin at the final month of the year. And I think that was pricing in some changes. But is there going to be wholesale changes where they really change everything in the healthcare space? It's unlikely. It's just really hard to do. You still got innovation. The sector's trading at a 20% discount to the S&P. That's very attractive. There's an earnings story. So I don't think it's going to be as bad as it may look.
Matt, great to see you. Thanks for your time. Well, Apple is set to report its first quarter results after the market close. Investors looking to get more clues on prospects for big tech. Here with a closer look at what investors are watching, Yahoo Finance's Dan Howley. Hey, Dan.
Hey, Julie. Hey, Josh. Yeah, this is going to be a big announcement for Apple. I mean, everyone is really big for Apple, but this one in particular, just because the stock is off of 3 downgrades as of late. Those include some from Loop Capital, as well as Jefferies and Oppenheimer. So there were 3 downgrades on the stock, mostly on fears of lower than expected iPhone sales, poor performing Apple AI, not getting people as amped up to go out and buy new iPhones, and then, the 800-pound gorilla in the room, performance in Greater China. And so those are the things that we're going to be looking at in particular. So for the quarter, let's just go over what some of the numbers are expected to be here. Earnings per share are expected to come in at $2.35. Revenue, $124 billion. That would be a jump from $2.18 and $119 billion the company saw in the same quarter 12 months ago. Now, the iPhone segment in particular is supposed to bring in $71 billion. That would be an increase from $69 billion. Services expected to be $26 billion, up from $23 billion. China revenue, general China revenue, or Greater China revenue rather, is expected to get a slight boost from $20.8 billion last year to $21.5 billion. But all of the reports that have been coming out is that Apple's market share of the market in China has been slipping, and that the local rivals are really starting to muscle out. And so that's one of the biggest fears, I think, that investors have, analysts have, and that they're hoping to hear some good news about on today's earnings call.
It's not just Apple, of course. Intel after bell as well. Dan, what are you looking for there?
Yeah, Intel, I mean, look, anything about the CEO hunt. Right now they have 2 co-CEOs. There's been no real definitive explanation as to when we can expect firmly a permanent CEO put into place. And this is a company that's going through a major overhaul, trying to turn it around and kind of restore it to that position as a leader in the chip space. For the quarter, the company's and Wall Street's anticipating 12 cents earnings per share on revenue of $13.8 billion. That's a steep drop from the 54 cents per share and $15.4 billion it saw in the same quarter last year, although anything is an improvement over the performance that the company had in the prior quarter, which was a historic drop as far as earnings go. And so this is really going to be a story about what are they doing on the foundry side. That's really been the kind of bugaboo for them, where they're trying to get the foundry to be a area for third parties to come in, have their chips built alongside Intel. They're doing everything to try to make it so that it's as separate as possible from the design side. And then where are they as far as 18A, that chip line, and ensuring that they can get other partners to actually use that chip, Microsoft, Amazon, and others. So it's going to be an interesting call. I think, it's got to be better than the last quarter, though.
Yeah.
We'll see.
Bottom line, it's a really busy afternoon for Dan Howley. That was my takeaway.
I got an extra large coffee sitting there. I'm gonna have another afterwards. We'll just keep pumping away. I got skee ball at 10 o'clock tonight. That's crazy.
Oh, wow.
Yeah.
That's a lot.
I would like to do that.
And the night on skee ball.
It's rough.
It's Dan Howley. Thanks, Dan. All right, we're going to have full coverage, of course, of Apple and Intel earnings. It's going to start at 4 p.m. Eastern today on Market Domination Overtime. Meanwhile, the U.S. economy grew at a slower than expected pace in the fourth quarter, 2.3% versus the 2.6% expected by Wall Street. For the year, GDP clocked in at 2.8%, not too far off from prior year. President Trump expects to impose tariffs on Canada and Mexico as soon as February 1st, with the potential for a universal tariff down the line. So how will tariffs impact the economy and its growth? Here with more is Ryan Wang, HSBC Chief U.S. Economist. Ryan, it is great to see you. Let's start with the U.S. economy, Ryan, and let's look ahead, because investors want to know how you think this economy evolves over 2025. Lots of balls in the air with Trump policies, as we mentioned, got tariffs, deportations, but how are you trying to think through it, Ryan? What are you telling your clients?
Yeah, thanks so much for having me. Well, you're absolutely right. There's plenty of policy uncertainty. I think what we can say is that we're entering this year with the economy still on a pretty good footing. Yes, the headline GDP number for the fourth quarter was a little bit lower than expected, but if you average the 4 quarters, 2.5%, still strong growth in consumer spending, pretty strong growth in business investment, although that rate of growth has decelerated a little bit. So, those are the positives. We're going in with a healthy labor market, pretty good economic momentum, inflation that has cooled somewhat. And then, it's these different policy areas. You mentioned tariffs, you mentioned immigration policy. I'd throw on fiscal policy and regulatory policy. That's pretty much your list of 4 key policy areas, all of which could impact the economy. And it could be that the first half of the year is more about the first 2, the tariffs, and also further changes that may slow net immigration in 2025. And then maybe the second half of the year is looking at the effects of some of those other policies, including what happens to taxes going into next year.
Ryan, as you mentioned, part of the strength of that last quarter's GDP report was the consumer spending, which outpaced the underlying number. It was up by 4.2%. I think that was the fastest since early 2023. How are consumers, I mean, there is some talk among economists, Claudia Sam, for example, wrote a column today talking about this, that the anticipation of tariffs could actually be inflationary. How do you think that is going to play out amongst that strong consumer spending cohort?
Yeah, that's a very interesting angle. Look, I think, there is some evidence that both consumers and businesses, of course, are thinking, and I mean, they're certainly aware of this possibility of tariffs, and it may be impacting decisions on the margin. Actually, I think we see some evidence of this at the business level, not so much from today's GDP report, but actually from the trade data that was released yesterday, which did show a very big increase in imports in December, particularly for industrial supplies. I think that's businesses saying, look, we know we're going to have to order a certain amount of raw material over the course of the next year. Let's just do it, right now. Why wait? Right. So I think some of that behavior does occur. I think at the consumer level, it gets a little bit trickier. I mean, yes, perhaps in some cases, consumers may be rushing their purchases, but I think, by and large, consumers are still spending on what they want and what they need, and that the main driver of consumer spending is more about underlying fundamentals like the strength of the labor market, the unemployment rate, et cetera.
The strength we saw, in the consumer today, Ryan, the numbers we got, I mean, showing that clear consumer resilience, is it kind of across the board resilience, Ryan, or is it still more of that sort of bifurcated theme we've talked so much about?
Well, that's very true. In the aggregate data, it can be difficult to tease out that bifurcated consumer. Sometimes we refer to it as a kind of a K-shaped economy, this sort of thing, where, of course, there's a big difference between the spending wherewithal of households across the income spectrum. So I think that still is a very relevant theme. That's not going to go away. I mean, we all know that although inflation has cooled off somewhat in recent years, the price level is pretty much high across the board. Prices are up easily 20-25% compared to a few years ago. So, look, I don't think that's going away. I think in terms of the detail that we do see in terms of product mix, goods and services, I would say the growth is still relatively widespread. Look, we are entering a different phase for the economy. There's not going to be as much growth in goods spending in particular. That has been particularly strong in previous years. Now, I think even holding steady is a pretty good achievement. That may be part of the reason also that actually businesses may not need to build inventory as much, because inventory is kind of a goods-focused area of the economy. So, look, there are some mixed trends at any given point in time. But to take it back again to the labor market, that's probably the most important driver. The bottom line is that 6 months ago, 3 months ago even, the Fed was quite concerned about what was going on with the unemployment rate. And then in the last 6 months, it hasn't gone anywhere. So that's really alleviated a lot of the near-term concern.
And just quickly, Ryan, do you think that risks to the labor market are more skewing to the upside or the downside right now? In other words, you sort of share what seems to be, reassurance from the Fed that the labor market is kind of balanced and okay at the moment.
Well, here, generally I do have a fairly benign view of the outlook, but I'm not convinced that the unemployment rate will simply stay at its current level of about 4.1% all through the entirety of this year. That would be a big ask. Of course, that's what policymakers would like to see, a stable unemployment rate, neither higher nor lower. But on our own forecast, we have the unemployment rate moving to above 4.5% later this year. Not extremely high, but still, indicative of the idea that businesses still have to have demand for labor to keep job creation continuing, right? So this is always the tricky balance. And then even when we think about some of these policy risks, let's say tariffs, for example, the first thought of many is that these could be inflationary, but at the same time, they could also weigh on growth, depending on how it comes through and depending on, business pricing power, the ability to absorb these potential tariffs. That can actually be a growth negative. So I don't think it's a straightforward story at all. I think we have momentum that'll probably persist in the near term. And then, over the course of this year, I'm sure we're going to get some more surprises.
I'm sure we will, Ryan. As the chair said yesterday, there's a lot of uncertainties. Things could go a lot of different ways. Thanks so much for your time. I appreciate it.
Thank you very much.
We're just getting started here on Market Domination. Coming up, the AI trade. We'll discuss big tech spending on data centers and get some top stock picks in the space. Plus, trending tickers. We'll break down some of the biggest movers of the day. And the DOJ is suing to block HPE's merger with Juniper Networks. We'll discuss more of what we can expect from President Trump's Department of Justice. Stay tuned. After reporting quarterly results, Meta and Microsoft making it clear in their earnings calls that they are not slowing data center spending. Now investors have to figure out if they keep the same AI playbook or they should start repositioning. Here to discuss is Mark Lehman, head of Citizens JMP, and a nice treat for us in from the West Coast in studio here with us.
How about that?
We're very excited about it.
I'm more excited.
So
Thank you.
Let's talk about this week, right?
Yeah.
For this AI trade. We had DeepSeek on Monday, sort of sending everything down. Then we're starting to get the earnings. These companies are still spending. They don't seem to be changing their paradigm. What should investors be doing?
Well, I mean, it's only Thursday. It's been quite the week, and the $6 million man came out on Sunday and took $1 trillion out of the market. But like you said, fundamentals in the reporting of these Magnificent Seven has begun, and a lot of those numbers are really good. You're right. Tech spending is not slowing down, and I think the consumers of AI and the consumers of the data are, at least at this juncture, proving to be the winners. And that has always been the theme, right? I just think there's going to be a lot of noise. There's going to be a lot of rhetoric, and this week has been no different. But I think it's the same theme, right? The winners are bigger, and they are winning bigger, and you have to be ready. Think about it. Meta traded 10% lower than it is today 2 days ago. So you had an opportunity, if you're nimble enough. And I'm not saying every investor should hit the bottom, but my point is you've had these opportunities over the last multiple years, and I have heard that tech is overvalued since I started on Wall Street 30 years ago. I really have. And this week is a good example of that. But you got to be prepared, and you also, things do change. Things do change.
Yeah.
Mark, what about DeepSeek's claims, right? Because they say, listen, we created this model, we did it faster, we did it cheaper than the Americans, less energy. Do you believe all those claims? Are you skeptical of those claims?
I believe a lot of those claims will be thematic for the next decade and beyond, right? That is, you could have said that about storage, you could have said that about semiconductors, you could have said that about software, you could have said that about cloud computing. I can go on and on. We've been hearing about this forever. The ramifications of which, obviously, are really important, how to figure that out. But we were talking, before I got on here, 45 years ago, a gigabit of storage cost $465,000. 45 years ago. Today, it costs a penny. Okay, I will do that pregnant pause. That costs a penny. And I think that thematically, Moore's Law is alive and well. So do I believe that a $6 million investment should take $1 trillion of market cap out? I don't. But what I do believe is that theme will play out. And the consumers of that data, and people who can manipulate that data for more successful outcomes, whether it be in technology or healthcare or energy or consumer, whatever that is, who are we? Financial services like our bank and Citizens. Those will be the winners because it's faster, better, cheaper.
So does that mean then that NVIDIA's moat is not, which it has built up, in what has been a commoditized business, has built it up by building more advanced chips?
Yeah.
But is what you're suggesting is that moat is not as defensible as it seems?
I think it calls into question whether that moat and that premium multiple that they've earned. Now, they've grown into their multiple by earning as much as they have. And we'll have to wait another 4 weeks to see what they have to say. And I think they'll have a lot to say. But I think potentially that moat and that speed with which they have been able to garner, and we have Intel reporting today. When I started in my career, Intel, we always laugh, Intel sort of created AMD so they'd have fake competition. Now, Intel, the CEO of NVIDIA, has a bigger net worth than the entire market cap of Intel. I think it shows that things change really rapidly, and you got to be innovative, and you got to be really ahead of the curve. But what I think you have to remember is semiconductor multiples have always been tempered versus software multiples. And I think that's the question investors have to face, which is, what do you want to pay for it? Because right now all you've got to do is grow into the earnings. You haven't really paid that super premium multiple.
Do you think, Mark, if AI gets cheaper, what are some, we talked to Intel, but Apple's reporting after close today too. And one question, I was talking with an Apple analyst today, longtime guy who's covered the company. He said that was kind of one question for him. If AI is going to get cheaper, does it mean app makers can create AI experiences, that many more of them? And what could that mean in terms of tailwind for Apple and an upgrade cycle? How are you kind of trying to think through that?
I think anything that makes technology cheaper will spur investment and will spur innovation. And I think the people who benefit from that will be people like Apple. It'll also be the software companies who are big consumers of it. You watch this ascent with Salesforce and obviously with Meta and people who are really building things off of that data. I think that is accentuated by what we learned over the weekend. And again, I'm not sure I put 100% credence that this has changed everything permanently. And I've heard about fears of the data center market being, erupted. We heard about when VMware did it years ago. We thought cloud computing would erupt it. It's only accelerated the growth of data centers. It's accelerated data. And I think, again, those consumers will benefit. It'll be bigger, faster, cheaper. And again, it applies across platform. It's not just technology.
So just quickly here, you mentioned Meta, I think, as a pick. You mentioned in passing Salesforce just then. Like when you say people have to be careful about how they play this, you have to pick your spots. Those are two of the spots you like, I take it?
It is. They are.
But how should investors figure out how?
Well, it's a good question. I mean, we were fortunate at Citizens to be part of Reddit's IPO, which was a little over a year ago, and that stock has performed phenomenally well. And you look at what they have been able to create, and that's not a new company. That's a 20-plus-year-old company, and they decided to go public a year ago, and the premium multiple they're getting in the public markets because they've executed better than anyone thought they could and would. And I think that when you fear that 7 companies have too much market cap, there's lots of places you can win, and some people have gotten a little less multiple than that. We've looked like just this week, had a company like Snap, which has been kind of hot and cold for a very long time. We were part of their RPA years ago. And you look at the noise around what's going on with TikTok, and you could look at that and say, boy, that one's potentially benefiting. It's domestic. It's got a little bit of maybe a halo because TikTok's under cloud. I think investors have to be very, very aware that these multiples and this volatility is here to stay. And that gives you big opportunity, and it also, makes people a little tenuous, and that's tough.
Yeah, you got risk out there.
Yeah, there's risk out there.
Well, Snap reports on Tuesday, so
Yeah.
that'll be interesting to follow that. Mark, thank you so much, and you're going to come back,
I am.
speaking of Intel, and talk a little bit about those earnings.
I look forward to it.
Thank
Thank
you so
you.
much. Now, time for some of today's trending tickers, sponsored by Tasty Trade. You can scan the QR code below to check out the best and worst and most trafficked stocks of the session on Yahoo Finance's trending tickers page. First up, shares of Las Vegas Sands seeing a pop, the casino operator delivering a beat on revenue and better than feared results for the fourth quarter. We always like to remind folks it might be called Las Vegas Sands, but a lot of their revenue comes from Macau in China, and that area in particular, Josh, did a little bit better than analysts had anticipated.
Yeah, the biggest intraday pop since September 2022 on this one. Q4 net revenue beats what the street had been looking for here. JP Morgan, they like this name, they're overweight. They told their clients results were more than good enough. We see why their Macau operations should grow nicely into 2025. Hasn't actually been great for this name over the past 12 months, but nice move in today's trade.
Yeah, and a lot of their properties still saw year-over-year declines, but still came in ahead of estimates.
Meanwhile, Whirlpool, let's take a look at their shares. They are sinking. They're going the other way as the company misses fourth quarter estimates on the top and bottom lines. Looking ahead, its full year forecast also underwhelming Wall Street. So sinking today, quarterly sales, adjusted earnings miss. This was the biggest intraday decline, looks like since October 2023. Executives saying they expect the global industry to be approximately flat in 2025. In the U.S., we expect to see similar demand trends that we saw throughout 2024. That is not comforting investors.
Yeah, definitely not. Now, in addition to the namesake Whirlpool brand, they also make brands like Maytag, Amana, KitchenAid. And so the lack of willingness of people to spend on big ticket items is obviously an issue for them. They were also asked about tariffs.
Yeah.
Because one would think maybe would have an effect on them. They actually make most of their stuff in the United States that they are selling into the U.S., not all. But they said for that reason, tariffs could have a positive effect on the company. But CEO Mark Bitzer said sometimes they also, quote, have unintended negative consequences. But they said more than 80% of the products that they sell in the U.S. are made in the U.S. So interesting there to see, that there are some companies like that might see a benefit potentially.
Yeah, tariffs on them. And then, of course, also for this name, you just think about that backdrop of what we discussed a lot about, which is that challenged U.S. housing market.
Right, definitely. You're not buying a new dishwasher.
No.
If you're not going into a new space, probably, unless it breaks. Tractor Supply shares are slipping after fourth quarter same-store sales came in below analyst estimates. The farm supply company did highlight it expects 2025 comparable store sales to improve throughout the year as macro headwinds abate. This company was a very strong same-store sales performer sort of last year, right? Or I should say 2023 now, and then saw a bit of a dip here. But for the full year, comp sales should rise 1 to 3%. The stock actually closed at a record back in October, but since then it's been sliding.
Yeah, I saw comparable average ticket decreased about 1.7%. Analysts pointed out that is actually the biggest decline in years for this name. Analysts were saying as for the outlook, that it actually aligned with the projections offered at the Investor Day back in December, but stock's down more than 4% right now.
Yeah.
All right, coming up, the DOJ suing to block HPE's Juniper Networks merger in what is the first antitrust lawsuit since President Trump did take office. We're going to break that down. That's coming up next.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
We got some more trending tickers for you. And remember, you can scan the QR code below to check out the best and worst performing stocks of the session on our trending tickers page. Such a busy earnings day, we had to get another one in. Oshkosh, those shares are skyrocketing. Company beating estimates on the top and bottom line for the fourth quarter. No, this is not the beloved overall maker, children's overall maker. This is the truck maker of a similar name. Oshkosh makes fire engines, they make military vehicles, and the vocational division at the company doing particularly well, which makes fire trucks as well as garbage trucks. So that's showing stronger demand than estimated.
Yeah, 2025 profit forecast beats. Growth in the vocational segment you talked about, defense segment, which would include light tactical vehicles. Guidance, by the way, coming up, that's after they posted this Q4 profit and sales that beat. Jeffrey saying positively surprised by the strength in vocational markets, resulting in a better than expected outlook for the business in 2025. Investors agree, Julie.
Yeah, and you know me, I go to the short interest page when I see a stock like this. The short interest is not very high at all. So this doesn't necessarily look like a short squeeze. It just looks like a positive surprise.
It looks like enthusiasm.
Or it looks like enthusiasm. The share's a little changed, though, over the past year, even with the big gain that we're seeing today.
Let's talk pizza, shall we?
Let's.
Next up, Domino's Pizza. Those are also surging today. Cleveland Research seeing upside for the company's comparable sales in 2025, up about 5.5% right now in today's trade. So Cleveland Research does say, listen, they're kind of talking about catalysts driving 2025 comparable sales. January, they say, probably kind of choppy due to weather, among other issues, but full year 2025 outlook kind of sounded more positive. They raised their 2025 comparable sales growth outlook, driven by stuffed crust potential. Stuffed crust was one variable to consider.
Have you ever had a stuffed crust
I haven't.
pizza?
Sounds delicious.
It's not bad. It's got cheese in the crust. I mean, what could be wrong with that? They also talk about third-party delivery expansion as being another area of growth for them. I was looking at how the stock is done here. It's up about 4% over the past year, so not fantastic, unless you contrast it with its main competitor, Papa John's, which is down about 50%. So it hasn't outperformed the overall market, but it has outperformed one of its main competitors. By the way, we get the results from the company on February 24th, so that's when we'll see if this research note is correct.
Circle your calendar. Your stock is not that much a street, though. Bullish.
Yes.
Like the pizza.
Relatively bullish, yes. All right, coming up, fears swirling over federal funding whiplash. We'll look at how investors can navigate it all. More market domination on the other side.
Earlier this week, the Trump administration rescinded a memo freezing all federal funding, but the move has spawned confusion, fear across several sectors, including biotech, where the loss of research funds could have a huge impact. Joining us now to help us understand how to play the sector is Mara Goldstein, Clear Street Director of Research and Senior Equity Analyst Biotech. Mara, great to see you. You're on set. So let's start there, Mara. You know, the back and forth with the federal funding. Walk us through how you were thinking through that and what it could mean for the sector you cover.
Sure, I think it's a little bit of optics right now. Clearly, you know, any disruption is typically bad unless it involves dismantling regulation. So, you know, the surprise announcement that all of a sudden all federal grants will be frozen, you know, you have to take a bit of a knee-jerk reaction. The reality is for the biotech industry, while research is the lifeblood of this industry, a lot of the research is being federally funded. It's not directly related to biotechs necessarily, but it does cause a bit of a hiccup because, you know, there are labs that are being funded that are working with biotech and pharmaceutical companies. There are clinical trials that are being funded through federal grants that are being run through, you know, big hospital administrations. So it just adds a layer of uncertainty. You know, companies that we talk to have certainly indicated that they think that this will pass, but it just, you know, in an environment that is, as you know, fraught with unknowns, it just doesn't help to have one more.
And what are kind of the other things that you're watching from the administration? You know, we've got day 2 of hearings to decide if RFK Jr. will be confirmed as HHS secretary. You've got other, you know, regulatory stuff sort of percolating. What's sort of most pertinent? Is it pricing issues? What do you think?
So I think we're walking a bit of a tightrope to some degree, and this is what our team thinks. You know, there's multiple areas that are being sort of explored all at the same time. So you have some nominees that are not necessarily science friendly, but maybe are more friendlier from a regulatory perspective. And so on the one hand, you know, it's better for companies if there's less of a regulatory burden. On the other hand, it's not great for companies if they're, you know, anti-science, you know, if you will. So I think we have to, you know, see how all of this plays out. But ultimately, you know, the factors that drive this industry are the ability to get drugs developed and to market, for companies to be able to create synergies, for M&A to happen. So there is a prevailing thought that the Trump administration will be friendlier from a acquisition perspective, from an FTC perspective, and that is good. You know, if you look at, there's already been a couple mid-size acquisitions that have occurred this year. So the sectors that struggle the most under the idea that we're in this environment that's less friendly to new technology are things like, you know, vaccines and genetic therapies and whatnot. But, you know, it's a process to really implement any change. So the market is right to have some, I guess, uncertainty to it. But I think, you know, our analysts feel that a lot of this will wash out as we get through the year. We're in the middle of sort of chaos, if you will, for the next few weeks, and then things probably settle down.
I am curious though, Mara, let's say the Senate did approve RFK Jr. What could he actually do, Mara? Do you think, do you think your sector you cover would even be in focus for him? He would have a lot on his plate.
Well, he does have a lot on his plate. Remember, it's not just about, you know, it's not just about biotech companies, but there are concerns about things like, you know, using genetic technologies, fetal tissue, and those have come in and out of focus for the government over the last 20 years. And so some would argue that when the government softened its stance on being able to use, you know, human tissues, that created essentially the modern genetic gene therapy industry. So there are things, but it is a process that has to happen. There will be a knee-jerk reaction. There will be uncertainty to any type of new legislation, for sure.
All right, let's get to some picks from you and your team. And I don't know that there's any theme with these picks, except in biotech, you just have to look for the products that seem like they have the most promise, right? So one of your picks is a company called Enliven, which is developing a drug to treat a type of leukemia. Tell me why you guys are focusing on that one.
So our analyst who covers that stock, her name's Kaveri Pullman, she thinks that it is really an opportunity to be disruptive. The data looks really good. This is a big area in clinical focus and also commercial development. I mean, you can't turn on your TV these days without seeing an advertisement for some type of autoimmune and inflammatory disease. So these are big commercial friendly markets. and blood cancers as well are areas where, you know, you see this as well. There just have been so many improvements in terms of how patients can be treated. And so being able to have a drug in the market that has a clinical advantage really does mean that you can get sort of priority positioning for it. And so Kaveri's universe is very focused on finding best in class, and she believes that this is a company that has that potential.
What about Mirror Protagonist, PTGX, which has had a nice run already? It's about 50% over the past 2 months.
And it's the same thing. They've had good data. They're developing drugs in big consumer-friendly markets, and they have the ability to put drugs in the market that can potentially be best in class.
And then looking at some of the other picks that you're looking at, again, like it's so interesting when we talk about biotech names because they're not household names, right? I guess the hope is that one day their drugs will be at least household names in certain populations here. Delcath is another one that you're looking at here, and they make a drug called, I'm going to hazard a stab at this one,
Hepzato, yes.
Hepzato. What does that do?
So this is a company, and our analyst Bill Maughan covers this company. This is a company that has this drug. It's a small drug for a small oncology indication, but the point I think for him is that they're commercially executing very well, and so they have the ability through not just this execution but improvements in in the technology over time to bring additional drugs to market, and that widens the therapeutic area. So you sort of have a tale of two different kinds of companies. On the one hand, you have companies working in big markets like Kaveri's companies. On the other hand, this company that Bill covers are working in smaller niche markets where you can command premium pricing. You know exactly who the patient population is, how to target them very exquisitely.
Interesting.
Mayur, thanks for your time, those picks.
Thank you.
Thank you. Hewlett-Packard Enterprise's $14 billion acquisition of Juniper Networks hitting a speed bump now. The U.S. Department of Justice suing to block that deal, claiming it would hurt competition within the enterprise wireless market. This suit marks the first to be brought by the Justice Department under the new Trump era. Juniper Networks and Hewlett-Packard Enterprise saying in a joint statement that the Department of Justice analysis of this acquisition is fundamentally flawed. Mercatus Center Senior Research Fellow Alden Abbott joins us now. Alden, it's great to see you, have you on the show. Let's start right there, Alden. The companies say, listen, the DOJ, their analysis, they're thinking about this, it's all wrong, it's off, it's flawed. What do you think, Alden?
Well, this is all going to turn on what the court agrees a market is. Justice said the merger is going to create two dominant firms in wireless local area networks. The leader, Cisco, and Hewlett-Packard together will have over 70% of the market. Traditional antitrust, that kind of merger would probably be struck down by the courts. The problem is that I think Hewlett-Packard is going to say, no, we are really bringing together certain new cloud capabilities and AI capabilities that are joining together to improve offerings. And they were going to reject the idea that there would be higher prices and lower qualities to the consumers of local area networks, but it really turns on whether the court buys a justice market definition.
Well, and it's interesting in the complaint, Alden, because the DOJ says that effectively Juniper, because of its existence, has forced HPE to be more innovative and also to offer competitively priced products. Have traditionally these kinds of arguments, have they been convincing in court?
Yes, I think traditionally the most convincing argument is that you say you have a firm, you'll have two dominant firms in the industry, and the number two firm is getting larger. Now, it's sort of all, and that usually has been disfavored because it's two firms with 70%. I think that Hewlett-Packard could say, wait a second, we're going to be more effective in competing against Cisco. It's not really something where we're going to harm competition. Instead of Cisco being having all this power, we are going to be able to enhance our AI and cloud, and therefore Cisco will have to compete more aggressively, and that will help consumers. I think that's a hard argument to make, because usually where you have a very concentrated industry, again, buying the market definition, courts are reluctant to buy that argument if the justice says this is very concentrated, there are real serious risks here.
In terms of timeline of what now happens next, Alden, is it the pretrial hearings over the next few months? Is that what we should expect?
Yeah, right. I mean, I think they're going to try to go and get an injunction. And the near term, I haven't even had a chance to see asking for temporary restraining order. But yeah, the injunction, you're going to have usually a hearing, or you get expert economists and battling it out, probably over the market definition and over efficiencies. So it could take several months, unless, of course, Hewlett-Packard decides to drop the deal and decides. But so far, based on its press release, it seems as if it's going to try to aggressively defend itself in this federal court injunction action. And the key is a district court judge. District court judges, some are much more experienced in antitrust than others. Some also are much more willing, I think, to give the government to look at traditional measurements by the government. So I think it depends on the judge as well.
Right. Alden, I want to broaden it out a little bit. As we talked about, this is the first, of course, antitrust action brought in the Trump administration. Hasn't been in office for very long. So is this a signal? Does this tell us anything? Does it set any kind of tone for what we can expect from antitrust from this administration?
Right. Well, I think that for those who thought that the new administration will be soft on antitrust or soft on mergers, think again. I think you're going to get maybe less of a populist talk about labor and environment and things of that sort. But the new head of the antitrust division, nominated Gail Slater, has been an aggressive supporter of antitrust. She worked for a Democratic commissioner at the FTC. She's probably going to push an aggressive point of view, and the new leadership of the FTC as well. So I think that merger policy is going to be tough, and it's a pass is not being given. I think we'll see how additional cases bear it out, but I think you're going to have traditional but very aggressive antitrust centered on what is called a consumer welfare standard.
Alden, thank you very much for your time. We really appreciate your perspective.
Thank you.
Markets nearly erasing gains in the past few minutes. President Trump doubling down or really just reiterating his threat to implement tariffs against Canada and Mexico. Remember, we are approaching that February 1st deadline on which he said that he would be imposing those tariffs. And so stocks have come down. They've sort of been fluctuating a little bit. But we are seeing this being felt in other areas of the market. Ford, General Motors shares under pressure. GM shares hitting the lows of the day on this news. We also saw a big movement in the Mexican peso and in the Canadian dollar as well. So we'll keep monitoring any developments. Again, this wasn't anything new. He's just reiterating. Maybe the market hoped that he would not. We'll be right back. There's the closing bell on Wall Street, and now it is Market Domination Overtime, sponsored by Tasty Trade. Let's take a look at where the major averages ended the session here. And you see all three major averages in the green, but I actually want to take a look at the Yahoo Finance Interactive, because just those lines don't tell the whole story. In the past half hour or so, we got some headlines from the White House where President Trump was speaking to reporters after he signed an executive order regarding aviation safety. He was asked, "You still going ahead with those 25% tariffs on Mexico and Canada?" He said, "Yep, I sure am." And the markets did that. Now, this wasn't news, right? We knew that this is what he is planning, but perhaps there were some hopes for some last-minute reprieve on the part of market participants. Just shows sort of the delicacy or the sensitivity of the market to these types of headlines. The S&P 500 finishing in the green, but similar move there that we saw on those headlines, falling and then coming back up 0.5% on the day. And the Nasdaq Composite, again, similar move, but up 0.25% on the day. I also wanted to show you the move in currencies on the back of those headlines, because there it was more dramatic, which is what you might expect. The dollar versus the Canadian dollar spiking on those headlines, coming back, giving back a little bit, but then still sort of keeping that move intact. And then finally, the Mexican peso, similar move there. Jared Blickery, it just shows, I guess, you know, the volatility is alive and well in this market right now.
Yes, it is. And the time of day is really interesting. This is a kind of movement. And let's go back to the Wi-Fi Interactive. I'll just plot the Dow real quick and spend a second on this. This is like a non-farm payrolls move. This is a type of move that you would see at 8:30 in the morning in reaction to a large report where there's no liquidity in the market, not past 3:30 p.m. when you have all kinds of institutional money in the market. So yes, this is something to watch out for. This is an interesting precedent. But let's move on here. 10-year T-note yield fell 4 basis points to a 5-week low today. Now it's camping out around 4.51%. That's far cry from 5, also 4.75% where it was recently. And let's get straight to our price action in the sectors. And this is a Nasdaq. We'll move over to the sectors. Everything in the green here. Utilities on that move lower, perhaps in the 10-year. That's up 2%. XLRE, that's real estate, another interest rate sensitive sector. That's up 1.3%. Healthcare, arguably a bit defensive, but also on the move recently, continuing some of those recent gains. That is up over 1%. Industrials rounds out the top 4, and everything that was up more than 1% today. What came in last was communication services and tech. So those are the mega caps that you see right there. And Microsoft, a big part of that, at least in terms of tech. Also, Apple not really contributing. It was down 0.75%, but Microsoft down 6%. And Comcast, I'm looking at here, that was down 11%. Guys?
Thank you so much, Jared. Appreciate it. Intel fourth quarter earnings crossing the wire moments ago, and we're bringing back Mark Lehman, who's going to react with us in just a moment. But first of all, Intel coming out fourth quarter revenue, $14.26 billion. That is a beat of estimates, as are earnings per share, which came in at 13 cents. That's a penny above estimates. But the company is giving some guidance for the first quarter here that's below estimates. First quarter revenue will be $11.7 to $12.7 billion. Analysts have been looking for about $12.9 billion, and the company says adjusted gross margin in the first quarter will be 36%, 39.3% is what analysts had been anticipating. Interesting here, too, it looks like that Bloomberg spoke to the current co-CEOs, or at least the acting co-CEOs who took over when Pat Gelsinger left the company, and they said they don't have any update on the CEO search at this point in time. I should also note that in the last quarter, the foundry business, the one that is sort of most controversial and one of the most controversial pieces of strategy under Pat Gelsinger, that is for Intel to make its own chips as well as potentially make other companies' chips, that the revenue for that came in at $4.5 billion, which was in line with estimates here. So that we'll have to see how that ends up going forward. The company is still talking about that it intends to spin that off as an independent subsidiary, but it doesn't look like that there is any particular update on that progress. Again, we've got Mark Lehman here with us of JMP, Citizens JMP, here with us in the studio. You know, it doesn't seem like Intel necessarily is making the progress that investors want, all the stocks bouncing around a little bit.
And obviously the expectations were really low for this quarter. And I think until you have some news about a new CEO, you're not going to see a big change in their business, and it'll chug along here at the bottom. Yeah, I mean, change is hard. And obviously we know from NVIDIA and others that innovation's accelerating, and if you're not part of that, we don't talk Intel Inside anymore. In fact, we probably never will. And I think that's an incredible statement versus what we saw.
What do you mean by that? Just that the brand does not mean what it did?
It doesn't. I mean, you think about innovation and you think about growth and you think about the things that are charging and moving our economy forward. I don't think a lot of tech innovators think of Intel, and that tells you a lot.
Mark, we're going to bring in another old friend of ours into this discussion. That is Corey Johnson, Epistrophe Capital Research Chief Market Strategist and host of the Drill Down podcast. Corey, I know that you follow Intel very closely as well. I mean, what do you think Intel needed to do this quarter, and did it do it?
Yeah, I mean, it continued to make a mess. I mean, the stock's down 54% in the last year for reasons. So the fact that it's kind of flat and after hours here, this is not a good print. It's not a surprise, but it's not a good print. And across the board, there's little things that are maybe a little bit better than they were. Foundry business a little bit up sequentially, but they didn't invest billions in the foundry business to have it to be up a little bit sequentially into a fourth quarter. And to Mark's point, I mean, this company is not what it used to be, and it is not revered by the startups and by the companies that are doing cutting edge things in Silicon Valley, and yet it's struggling to do the things that it used to do. The data center business is, it was still fine, I guess, kind of flat again, quarter over quarter, but this is. It's a growth stock. It's a test stock. This is a time for technology. It's a time for semiconductors, and Intel is. Maybe things are really bottoming out here, but I think to Mark's point, a new CEO is going to have an exciting strategy here for what to do with this business. Spinning off the foundries, it'd be nice to spin off the foundries when they're doing really well. So Intel can really collect on that business, and they're just not there yet.
Well, and I'm seeing a headline here that they say the external foundry wafer revenue won't be meaningful until 2027 at the earliest. So, kind of speaking to your point there.
I think that one of the things we don't give enough credit to Taiwan Semiconductor, give them enough credit for, is how well they do what they do. That, yes, they've got fantastic chip-making equipment from ASML, but they're able to have really fantastic yields and to use that equipment so very well. And Intel trying to do the same with similar equipment isn't able to get that up and running yet. And this is not the fantastic Intel manufacturing capacity that we used to see from this company when it was the greatest manufacturer in the world, although they were only making Intel chips. It looks like they're not having that success with their Intel chips or with anybody else's chips either.
Yeah, I mean, Corey's right. I think the real...
I love it when he says that.
I've known you long enough to know that you're often right. But I think... listen, it's really hard for tech companies to reinvent themselves. Let's think back to some of the great tech companies. I can name a few. One we're about to hear from is Apple. Apple was trading for cash in 2002. Okay, Microsoft, the Wintel monopoly. I'll even date myself even more. Microsoft, the stock was flat from basically the late 90s to the early 2010s. It did nothing. Then Jeff Ubben took a 1% position for Value Act. He was the biggest active investor in the company, and we know what's happened in the last decade. IBM, a company we'd never talk about, has sort of reinvented itself a little bit, but it happens very rarely.
Sorta, yeah.
Sort of reinvented itself.
Well, I mean, the stock was up 12% today or something in earnings.
Yeah.
Well, and guys,
so that's my point. It's hard to reinvent yourself.
Okay, so let me ask you both. Let me put this question to both of you then, which is, what would Intel what would that reinvention even look like? Or is that not something that we even can conceive? You would need that sort of visionary leader to come in there and come up with it. Corey, I'll put that to you first, and then Mark can chime in.
I mean, there are some technological things that they just can't do yet. And so, yeah, it'd be great if they could make an NVIDIA chip. Well, no one can. Maybe AMD on the margin. It'd be great if they can get an 18 nanometer or 18-aught production up and running and be able to lead that and do that with great high yields and great efficacy and do it in the US. That would be a wonderful thing for a leader to decide that they should do. Pat Gelsinger has already decided that. The question is, can they do it? And so far, the answer has been no. This could be a good time for a new CEO to come into Intel because the expectations are so low, the performance has been so bad that ups, one of the two directions they're likely to go, but flat's probably not it.
And I'd agree. I mean, they have to be in the high growth markets. You see that in the data center market. You see that in AI. You see that in automotive and other of the fastest growing parts of the economy. They're going to have to be relentless and figure out where that is and be part of that high growth, high intensity market. And like Corey just said, they have shown no signs of it. This is not a new epiphany that this company is falling behind. It's been going on slowly, like a lot of things in life. It happens slowly and it happens quickly, and it's been happening for a long time.
So it sounds like neither of you guys would step in front of this, right? Would try to buy into this. Is it just NVIDIA's game here? I mean, Corey, I know you've talked to us about other opportunities to look at in the chip universe.
There's a lot going on there. First of all, I got to say that having been around Silicon Valley for so long, there's a lot of love for Intel. It had a really unique culture. There's so many great people who've worked there. They've had the best technologists over the longest term in semiconductors of any company ever. And so you've got to think there might be something in there to plumb right now. But I think that, they chose not to be very active in the mobile market, and that was a mistake. They got into the data center market late, but did quite well in that business. And that's still a business at a lower end that they can operate in. But it's a very different kind of business. But yes, there are so many other companies that are doing so many other interesting things and having much greater success. I think it's also surprising. I am certainly surprised, again, having covered this for a very long time, how fast things changed. It really seemed like it was Intel's game for at least a decade ahead, because that's how far out they were planning. That's how far out they've got to decide, make technological decisions about what their data centers should, or what their fabs should look like, what kind of equipment they should be using, what the right sizes of equipment are going to be and dies are going to be, and what lithography technology is going to work. Those decisions are made so many years out. It's amazing that they got leapfrogged, but it also means it's going to be so much harder for them to turn this around. And this is going to be a real tough one for Intel.
Yeah, the irony, of course, is that Moore's Law is hitting them. The creator of Moore's Law is hitting them. What I'd also say is it's not that big of a company anymore. I mean, it's a big company, but it's not that big of a company anymore. The question would be, if private equity or somebody looked at this and said, there's a corpus of this company where we have an amount of sales, an amount of revenue that we know we can guarantee sort of for that time while we really innovate, that would, to me, it's almost burdensome to be a public company right now for them. And I'm not saying that's going to happen imminently or anything's in the offing, but it's almost burdensome.
Without the fabs, and with a little cash from Mobileye maybe, because Mobileye seems to be improving things a little bit, and that might be getting more valuable. Maybe that gets them to a different place.
All right, we've got to leave it there, you guys. I could do this all day, and maybe even in studio with both of you at some point.
Someday.
Wouldn't that be a dream?
We'll all be together.
Corey, Mark, thank you so much. I appreciate it.
Great to see you guys.
You too. President Trump doubling down on his threat to impose tariffs on Canada and Mexico as of this weekend. And that news has been driving down shares of automakers Ford and GM. Yahoo Finance's senior autos reporter Pras Subramanian is in Charlotte, North Carolina, where he sat down with Ford CEO Jim Farley.
It's the Ford Performance Season launch here at Charlotte Motor Speedway. We're talking about products like Mustang, Bronco, and Raptor, but also racing, which has become a big part of the Ford brand. Joining me now is Ford CEO Jim Farley and also Racer-in-Chief Jim Farley. Jim, thanks for joining us and inviting us to Charlotte. Before we get into the fun stuff, I do want to talk to you about some of the timelier issues, the newsier issues of the day. We know that a new administration is in place, a new Trump White House. They're talking about some trade policy issues, maybe even tariffs for products in Mexico and Canada and things like that. What's your sort of take on that, and is Ford game planning for that?
Well, we think this will play out over the next couple months. And Ford has the largest U.S. manufacturing footprint. And so we're really encouraged about the administration's positive outlook on the auto industry and the impact on our overall economy. And we're really looking forward to working with them in a positive way so that we can get better outcomes to employ more people in the U.S.
We're hearing those engines roaring, kind of like the U.S. economy these days, doing pretty well.
Yes.
I wanted to ask you about, Bill Ford talked about Trump and said that he seems he has learned a lot since the first time in office to now about the auto industry in particular. Is that sort of your general take as well?
Well, I think we think there's a couple of policy areas that the administration is going to zoom in on because they're really important for our country. CO2 policy, the IRA credit, and as you mentioned, tariffs. All of them will have a tremendous impact on our industry. Ford's really well positioned in that regard. We have such a huge U.S. footprint, and we committed to the U.S. while many of our competitors built, trucks overseas. We don't. We build 100% of our F-Series here in the U.S. So we're looking forward to working with President Trump and his administration. We have a lot to do, but we want to build a stronger economy and a stronger auto industry.
So what just drove right past us was this super truck, this Ford EV pickup that went up Pikes Peak. It's a demonstrator, as you call it. Yeah. Jim, you've been driving this around today. Yeah. I got a ride in today. It was kind of insane. You mentioned the IRA tax credits and EVs. Yeah. What's sort of your outlook there for EVs? Just not just for Ford, but just the industry in particular.
Well, in the U.S., we're about 8% pure EVs and another double digit for hybrids. We expect hybrids to continue to grow. It's been a great story for us. We're up on electric and hybrid and plug-in, more than 30% year over year. So we're way over 300,000 units now. The EV market is we believe, for customers who have a duty cycle that matches an EV, which is mostly around town, not long distance. And we learned a lot going before everyone else. We've been number 2 to Tesla for 3 years now, and we learned a lot from those customers. And we think that the pure EV industry is going to start to circle in on the duty cycle that makes most sense for that customer, where frankly it's cheaper to operate the vehicles in electric than a combustion. But for longer trips, heavier vehicles, like more than 100 kilowatt hour battery, we think that we'll see hybrid, E-revs come in, plug-ins, and then for the certain duty cycles like Super Duty, we really believe, that's very difficult to electrify.
Right, and that's why we're focusing on smaller to mid-sized cars for the next generation of Ford EVs.
It is, yeah.
And how has that process been going?
Well, we're deep into it. We're just a couple years away from launching our second cycle of products. We're excited for everyone to see them. We have a really exciting platform that our team in California has developed. We're now doing all the industrialization. We quoted 50% of the parts. We're retooling the factory soon, and that whole new lineup of commercial and small affordable EVs will be coming out from Ford in a couple years, but we won't lose that swagger and that fun and that enthusiast bent that makes us different as a company.
Let's talk performance, right? Sure. Even with EVs, you have the Mustang Mach-E Rally. You got the Rally, which is a really fun and interesting car, but out here it's Mustang, it's Bronco, it's Raptor. What is the importance of these brands, these halo products, to the Ford brand itself?
Well, first of all, it's huge business. I mean, our off-road business alone is a huge percentage of our global profit, and it's growing fast. People really love not just off-road products, but enthusiast off-road products like Raptor. So these brands, this business is a vital part of our revenue, our profit, but also our brand image. And that's really important. We really believe that Ford, when it's at its best, is a great commercial brand and a great enthusiast product brand. And that could be a pickup truck, it could be a van, it could be anything, electric, partially electric. We think that's where our brand should be.
That was Ford CEO Jim Farley and our own Pras Subramanian. Coming up, we break Apple earnings and do a deep dive into that report. More market domination overtime coming right up. Markets posting gains on the day, even after a late session scare as President Trump doubled down on his tariff threat on Canada and Mexico. Joining us now, Sebastian Page, T. Rowe Price, Global Head of Multi-Asset and Chief Investment Officer. It's great to see you, Sebastian.
Likewise.
So I want to start with what we saw today in the markets, because it seemed to indicate, I mean, it wasn't new. It was President Trump reiterating his promise to impose these tariffs. What does it tell us about the market that we saw that sort of knee-jerk kind of reaction? Is there sort of a sensitivity to these types of headlines?
Well, you know, you just had the Ford CEO on the air, and he sounded pretty relaxed about tariffs, interestingly.
His stock price is not so relaxed on these kinds of headlines.
He looked remarkably relaxed.
Well, he's at a Speedway, so yeah.
But, you know, it's a risk to markets, but you have to look at it sometimes with a grain of salt, because they move pretty fast. The news cycle will move very fast on this. When I look at how markets are behaving, I'm seeing value stocks actually behaving defensively, and you saw that earlier this week. Now, there was some nervousness around AI. Market went down. Value stocks did quite okay. So yesterday I looked at the last 200 trading days. Turns out the 17 times over the last 200 trading days that the S&P was down by 1% or more, 17 out of 17 value stocks outperformed growth. Overall, they underperformed growth. But when I'm looking forward to the next 12 months, I'm thinking value can act defensively. It can be broadly diversified and have more downside protection. And I think somewhat similar, if not better, upside. So I like the trade. I like the overweight value in that context. And the tariffs don't really worry me about that trade.
Oh, interesting. So, and you're the asset allocation guy. So if you're adding to value, does that mean you're taking your foot off the gas on growth a little bit and on big tech?
Exactly. And we still own growth, and our portfolios are actively managed. So we have security analysts, portfolio managers that will choose what they see as the best big tech opportunities. So I think you should own it. I think it's a great long-term investment. But if I look out 6, 12 months, I'd rather have a tilt towards value. You know, you have potentially, I think, inflation risk to the upside. You have some pro-growth policies that can favor value. If you bring manufacturing into the country, if you get more M&As, if you get lower taxes, all of that could lead to a broadening of the earnings. Because it's not just the fact that the valuations are super barbelled. It's also the fact that the earnings themselves have been in the earnings growth. I think that's going to normalize. We might be approaching peak market concentration.
Maybe, although we've been calling for that for a little while, so we'll see. Speaking of value, I've been thinking a lot about utility stocks lately, which are a traditional value area, but have been trading, many of the individual names especially, have not been trading like traditional value names. They've been riding the AI data center rocket ship. So are they still a value play, and is that a place you would look?
We are looking at, but you have to be very selective in that space. And you saw the sensitivity. It's not just tech stocks that sold off with NVIDIA. It's providers of energy to the data centers. So it's not the utilities that we used to have. You're right, they're trading differently. But nonetheless, we have quite a few portfolio managers that like the space, and they're finding opportunities in that space. But you have to be selective.
And so when you look at the market overall, do you see it as an inflated market? Did DeepSeek kind of correct that? Did it take a healthy amount of error out of that trade?
You know, my views are a little bit consensus and boring right now. I think the economy is going to do just fine. I'm positive on the economy in the US for the next 6 to 12 months, but I'm worried about valuation. And that's kind of consensus.
Right.
Now, if you look at valuation, I don't think we're in a bubble. I don't think this is 2000. The tech sector had a return on equity of 15% in 1999. Now, it's 30% return, double the return on equity. We're talking about high cash flow generating companies. It's not the same environment. So I don't think we're in a bubble, but markets are fairly expensive. We do have an overweight to stocks. We're starting to trim it as markets continue to perform. We're trimming it a little bit. So I wrote in my note to you that I'm a reluctant bull. I'm a little bit of a reluctant bull, and we're starting to take profits. We're also de-risking a little bit on the high yield side, where we've been overweight. So we're putting some to cash And we like bank loans because it's a nice way to be short duration, to underweight traditional long horizon bonds.
Sebastian, what are you most worried about right now when it comes to the market?
Long-term rates. I think that's the risk in the market.
And even though they've come down, you don't think that risk is gone?
I don't think the risk is gone. You have deficits, you have tariffs, you have potentially a pickup in growth. And so all these factors can lead to continued pressure upwards on long-term rates. So I think, we like having a little bit more extra cash, some credit exposure because we don't expect a recession, even though spreads are really tight, and just very mindful of higher rates. And this dovetails with risks to inflation, to the deficit. They're all part of the same theme.
Right. Sebastian, good to see you as always.
Thanks
for coming
Likewise,
in.
thank you.
It. Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend and Apple earnings. We've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Don't go anywhere.
Hello and welcome to Ask Me for a Trend. I'm Josh Lipton alongside Julie Hyman. And for the next half hour, we'll break down the trends of today. First, we're taking a look at Apple as the tech giant's first quarter results just now hitting the wires. And let's get you those numbers. EPS first quarter, $2.40. That's versus expectations of $2.35. Revenue, $124.3 billion versus expectations of $124.1 billion. So beats there on the bottom and the top for Apple. Revenue did jump about 4%. Gross margins do hang in there, 46.9%. The street was closer to 46.56. If you go through the segments here, Julie, iPhone clocks in $69.14 billion. Now the street was closer to $71.04 billion. Services, $26.34 billion. That's versus expectations of $26.1 billion. iPad is a beat at $8.09 billion. Mac is a beat at $8.99 billion. Wearables, home and accessories, that is a bit light, $11.75. The street was closer to $11.95 billion. Finally, Greater China clocks in at $18.51 billion. I did have the chance to speak with CFO Kevin Parwick about these numbers. He did point out to me the install base of active devices has reached a new all-time high across all products and geographic segments. About the iPhone number, I did ask him, obviously, did he come in lighter than what the street was looking for? Were there puts and takes that maybe the street and analysts had missed there? He pointed out, listen, iPhone results roughly flat. We saw where we rolled out Apple Intelligence, he told me, it was better than where they had not yet rolled Apple Intelligence, and said that iPhone 16 overall, since the launch, doing better than iPhone 15 did. He called these positive stats. Because of that, I asked him, given the difference in rollout there with Apple Intelligence, any update he could provide right now in terms of when European or Chinese regulators would approve Apple Intelligence. He said there was no update to give on that front as of yet. I asked him another question. This is one that had come up in conversation I had with analysts who kind of raised this question, are we still very early in consumer AI generally? Is it still too early, they asked, to create a really truly powerful and sustainable iPhone upgrade cycle? He said, listen, we are just starting to roll out Apple Intelligence, basically saying it's still early days. The feature set's expanding. First chapter is kind of how he summarized it. On DeepSeek, obviously that came up in conversation. Claims, again, it created a model at much lower cost than American rivals. As the cost of AI did come down, could that mean app makers, I asked him, software companies, could create that many more AI experiences? That's one theory out there, that long-term that would be a tailwind for Apple in the upgrade cycle. In general, he just said, listen, we look at innovation to drive efficiency. China, I do want to get to that and what they're seeing in the business there. And I asked him whether there are any shifts over there in terms of the macro, in terms of the competitive landscape. He said, listen, as for the results, if you look at the decline, he said some of that is a reduction in channel inventory. He said Apple Intelligence, he stressed again, has not been made available in that market yet. He also noted how national subsidies have just started rolling out there in January. So bottom line, we see beats on the bottom and the top. Looking at the initial reaction of shares here, we're flat. Remember, we don't have guidance yet,
right.
Julie. Very importantly, that's going to come on the call at 5 p.m. Eastern. You wouldn't expect formal guidance, but more color and commentary.
Yeah, I mean, the stock's been bouncing between gains and losses ever since these numbers came out, in a pretty tight range here as investors are perhaps waiting for more. But I think the confirmation of all of the chatter that's been coming out in recent weeks, that Greater China sales fell by 11%, that is something that is going to be a worry to investors. Even if, the company says, yes, we're going to roll out Apple Intelligence there and things are going to improve, I think really that remains to be seen, and investors are going to want the proof that that is happening, not just the promises that is happening, whether it's the company itself saying it or some of these research firms that get a handle on that once they start rolling it out. So that's something to keep an eye on. I also think we have to put the stock move in perspective here. The stock was up 30% last year, remember. It actually hit a record high the day after Christmas, December 26th, and since then it's down about 8% or so. So it's still trading relatively close to a record high. When coming into this report, it had dipped and then climbed a little bit. So people were maybe looking for a not worst case scenario for these numbers. And the numbers are, I don't know.
Let's see what the analyst makes about this. Joining us now for more color on Apple's first quarter results, let's bring in New Street Research Technology Infrastructure Analyst Antoine Shkabivan. Antoine, good to see you. So the numbers are out. Interested to get your first take on the report, Antoine. What do you make of them?
Hi, Josh. Good to see you again. So Yes, iPhone revenues were down 1% year over year, so that's slightly below consensus, and that implies units down mid-single digits. As you mentioned, the key will be the color the company will provide for the March quarter, and Apple usually provides guidance for the following quarter on the call. So we remain concerned about the next couple of quarters. And that's for a number of reasons. First, we're not convinced that on-device AI will enable game-changing user experiences because the hardware is not game-changing. When you think about it, Apple Intelligence features that are tightly integrated with the operating system, with iOS, have not really gotten great feedback so far. And the top models are anyway already available on most iPhones through various apps. So do users really need to upgrade to use these technologies? Not really. And then on top of that, you have elongating replacement cycles. You have the fact that share gains in China, which have been a tailwind in the past, have now stalled. And so, yes, we expect downside to consensus for iPhone in the March quarter, the remainder of fiscal 25, and we expect color supporting that view on the call.
Antoine, let's dig into China a little bit more there, where sales fell by 11%. What do you think is the issue there? I mean, and it sounds like you don't think Apple Intelligence will help. So excluding the effect of that for a moment, because we also don't know when it will be approved to roll out on phones there, what is the issue in China? Is it a macro issue or is it a competitive one?
I think it's more a competitive one because in the past, when Huawei got phased out like a few years ago, Apple was able to gain a lot of share in China because there was no alternative to Huawei in the very high end. Samsung is not very present in China. And so that was a huge tailwind for Apple. And now that tailwind is reversing because now you see a number of players who have very competitive offerings in the high end who are basically competing with the iPhone. And so that's what's happening right now.
Antoine, another theme I want to get your take on is DeepSeek and this idea that you created a model at much lower cost than American rivals. And when I speak to some analysts, Antoine, they wonder, well, could that mean, app makers, software firms can create that many more AI experiences? And the idea being, could that long-term be a tailwind for Apple and the upgrade cycle? How are you thinking about that?
So, yes, when you think about, first of all, let's put a bit of context on the architecture of Apple Intelligence. So first, there's a large language model and a diffusion model running on the device that's handling like natural language interactions and generating images, interacting with like a demanding index, providing user context to those models. And second, there are some additional models running in the cloud. And those can be either Apple's own models or OpenAI's models. But simply put, on-device models will deal with maybe your diary and your address book, but they will call their cloud-based older brothers for tasks requiring broader knowledge and capabilities. And so now that we have that context, if you take like all the efficiency that DeepSeek and like all the news flow of recent days demonstrates, what that tells you is that you're still going to have a much more powerful model running in the cloud. Okay, even if you can make both more efficient, you're still going to have a more powerful model running in the cloud, and that model will still be required for broader knowledge, broader capabilities. And so I would say our conclusion here for Apple is no different than the conclusion we've provided for the broader tech supply chain, which is that if you have more compute available because you're simply optimizing your models, you're making them run more efficiently with algorithmic optimization, you're going to use that additional compute for better use cases. And you're still going to have a larger model running in the cloud. And so for us, what that simply means is that you're still going to have this kind of architecture with a more powerful model running in the cloud, and that doesn't change any competitive dynamics there, so to say.
So you don't need a new hardware, I guess, in other words. I want to ask Antoine about services for a moment, because that's one area where it looks like they beat estimates by a little bit. By my math, they saw revenue in the services segment rise by about 14%. For a while there, the narrative was, well, services is doing well at least. That's something that, that's going to continue to sort of chug along, be an engine for Apple. Is that enough at this point?
So I think, yes, services are probably, they're at an all-time high. That's of course, driven by like a collection of businesses, and they will likely continue to grow, in double digits in aggregate. But I don't really see much room for an acceleration here. So bottom line is, yes, you have like that. Those challenges that Apple is facing in hardware, in particular in iPhone, services that are unlikely to accelerate. So yes, I don't think that's going to save the game. I think maybe double digits growth is already very strong growth, and I don't really see much room there for an acceleration.
Antoine, great to have that instant reaction analysis and insight. Thank you so much for being on. Appreciate it. Coming up, our very own market reporter Josh Lipton talks about the biggest market trend of the day. That wasn't true. Josh Lipton's going to talk to Josh Schaefer, more asking for a trend on the other side. Fox, the broadcaster of this year's Super Bowl matchup, was originally looking for about $7 million for 30 seconds of ad time during the game, but demand has surpassed even Fox's wildest dreams, with the network selling at least 10 of its Super Bowl commercial spots for at least $8 million each. Joining us now to discuss is Joe Pompliano, Yahoo Finance Sports Report host. Joe, always great to see you and have you on the show. Let's start here, Joe. Big picture. What is it about the Super Bowl that is so valuable to advertisers and marketers?
The audience is huge, right? I mean, last year I had 125 million people watch the game. I was actually having lunch with a tech executive at one of the world's largest technology companies last week, and we were talking a little bit about media rights in general and why his company wasn't specifically interested in broadcasting NFL games. But he said when he talked to Roger Goodell and some of the other people at the NFL, he explicitly told them, we'll always advertise with the NFL. And when I asked him why, he said, it is the only sports league in America that can guarantee you 15, 20, 50, 100 million views depending on the game. That's why these brands are so interested, and that's why they're willing to pay up to $8 million for 30-second slots.
Joe, in terms of just broad interest, pricing, demand for the live sporting event, have we reached peak there or no? There is more runway ahead.
Yeah, it's difficult to say. I mean, everyone says every few years that this is probably the upper band of where we're going to be at. But if you look at what's even happened this year, 7 million was the record that Fox was selling these ads for. And then a week or two before the game, they've now released data that they're selling them for 8, right? So certainly some of this has to do with the ability to replace other advertisers at the last minute. And maybe that's bumped prices up. But there's really no other asset in the world where you can go in and you can get 125 million viewers. So companies are going to pay whatever it takes to get these slots. There's a finite amount that they can get. And my guess is that the numbers will quickly approach 10 million over the coming years too.
Joe, switching gears, tomorrow, the deadline for objections in House versus NCAA, which would award athletes back damages for missing out on name, image, and likeness profits and set up a revenue sharing system. And that's exactly what this week's episode of your podcast dives into. Here's your guest, Jim Couvale, athletes.org founder and chairman, breaking down some of it.
NIL has proven that there's an immense amount of value brought by college athletes to their schools. That just like in the NBA, when $10 billion comes in and $5 billion of it goes to the players because of the NBPA's collective bargaining agreement with the NBA, there's a value allocation that should be increased from that $13.6 billion that college athletics makes. And that value allocation should increase in a way that goes to the athletes beyond scholarships. And so the NIL deals that have happened are kind of like comps, and those comps are going to be used to provide back pay to athletes going as far back as 2016.
So, Joe, break this down for us. Why are some people opposed against this settlement?
Well, there's a few different pieces to this. Mainly, people are upset because there's some college athletes that were preferred walk-ons or walk-ons that played college football or college basketball and feel that they should be entitled to NIL money, whereas this settlement, the $2.8 billion that's being paid out, is only available to scholarship athletes, right? There's some other athletes that played secondary sports that think they should be getting more money than some of the football players or basketball players, so those people are objecting to it, certainly. The other aspect of this is that there's going to be roster limits rather than scholarship limits, right? So some of the preferred walk-ons or walk-ons are upset because those positions on the team are now going to be replaced with scholarship players rather than preferred walk-on slots. Therefore, their spot may be taken. Otherwise, other players would be taken as well. So there's a few different moving pieces here, but I think the important thing to remember here is that the NCAA has 500,000 student athletes. There's never going to be a solution that makes everyone happy. This is the most all-encompassing solution and the best solution for everyone at this time, especially given that it's essentially now going to place a salary cap on college sports, where every college is going to be able to do direct revenue sharing with their athletes starting next year if this gets approved. It's going to be set somewhere around $20 to $22 million in year one. That will rise over time, and it's going to start to look more like professional sports. This is where we've been headed for a long period of time now, and I think this settlement finally accomplishes that and gives a little more clarity to the schools.
So, Joe, bottom line, you think this settlement goes through despite these objections?
Yeah, I think so. Look, we're too far down this road at this point, and the NCAA needs something to be able to enact their rules. Right now, the NCAA has rules, but they can't use those rules and enforce those rules because there's nothing backstopping them. So this settlement will allow them to give stricter guidelines to the schools from a revenue sharing perspective and from an enforcement perspective. And they'll actually be able to enforce those rules, which is necessary because when you combine the transfer portal with NIL and revenue sharing, it's become a mess where you're essentially on a one-year agreement with each school. You become a free agent and you can go to the highest bidder. I don't think anyone wants that in college sports. It certainly isn't that way in the professional level. And this settlement gives schools a way to counteract that.
Joe, always great to see you. Thank you for joining us. And be sure to scan the QR code below so you can stay up to date with the latest episodes of the Yahoo Finance Sports Report that drops every Thursday at 5 p.m. Eastern. Well, U.S. stocks closing higher as investors digest megacap tech earnings, and Yahoo Finance's Josh Schaefer joins us now with the trading day takeaways. Josh.
Hey, Josh, yeah, I want to start with those mega cap tech earnings because we've seen sort of an interesting trend play out here in the market. I'm going to flip over to our starting screen here. Mag 7 sort of keep diverging, Josh. We're not seeing a clear trend here among the Magnificent Seven, at least when it comes to a stock perspective. So you see here Microsoft shares falling over 6%, largely due to a miss in their cloud unit, right? So it'll be interesting to see what we hear from Amazon next week in terms of cloud. But Meta getting a boost overall. Apple shares were down a little bit after hours here. We're not looking at after hours trading there. But I guess my point being, we always sort of try and look at big tech earnings as this, can big tech earnings lift the market? Can big tech earnings not lift the market? You usually don't really see the stocks trade that similarly. And so that's something that stood out to me today. And one other one I wanted to highlight, Josh, is Tesla. Because this is just a great example of a stock that is not trading on fundamentals. I think most analysts and some analysts we spoke with this morning on some of our programs said, look, the earnings weren't that good. Gross margins are down. A lot of the key metrics for Tesla not looking great. Stock closed up 3%. So in some instances, this is a little bit of an example of know what you own and know how the stock trades. And Tesla is not a stock that is always necessarily trading on quote unquote fundamentals in that fundamental story.
And part of the vision, we should also point out with Apple, Josh, so they beat on the bottom, the top, missed on iPhone, missed on China. You don't have guidance there yet. You're waiting for the call, which starts at 5 p.m. Eastern. You wouldn't expect to get formal guidance, but at least more detailed color and commentary about what they see ahead.
And one thing we were talking about with Apple too, Josh, you and I were talking about this off screen earlier today, is just the stock has already been under a little bit of pressure over the last month. I think even over the last 2 months to some extent too, came off this high. We was at an all-time high right here, right? So Apple, some metrics came in a little bit below where the street had maybe hoped, but how much of that is already sort of priced in? I think it'll be interesting to hear from analysts after that call as well too, after they're able to hear a little bit more to see sort of where things stand with them. But one other thing I wanted to hit on, explaining the Fed's uncertainty and also just the tariff uncertainty. So I'm going to flip to the market here, Josh, because we had an interesting end to the day. And I want to just hit on this quick, and then I'll get to our chart. But we had an interesting end of the day. So some reports coming out about Trump speaking at the White House as he's signing, talking about tariffs, right? Big drop in the market. Why is the market so worried about tariffs? This was in our Yahoo Finance chart book. If I can get us to get back to the screen. There we are, Josh. Look at this chart, right? So what you can see here is what 25% tariffs do to PCE inflation. It's pushing up those projections. That is what Matt Lazzetti from Deutsche Bank told us is what makes the Fed so uncertain and what's making markets so uncertain. Now look, if those tariffs go above 25%, you're talking about PCE above 3. You get core PCE above 3, you might be talking about hikes again. So there's just a lot of wide uncertainty right now as we go into Saturday and hope to hopefully get a little bit more clarity.
Yeah, reports that there's still friction in Trump world too about tariffs. Do you go big? Do you go target?
Exactly what the numbers will be, right?
Yeah. Shall see. Joshua, thank you. Coming up, I break down what investors should keep an eye on tomorrow. Stay tuned. Time now for What to Watch Friday, January 31st, sponsored by Tasty Trade. Starting off on the earnings front, we're going to be getting some reports from the oil and gas industry, including ExxonMobil and Chevron. Exxon announcing results for the fourth quarter before the opening bell. Analysts expecting softer margins and weaker commodities to weigh on the company's Q4 results. Turning to the economy, another key piece of economic data coming out tomorrow. That's PCE data. That's personal consumption expenditures. Those are coming out in the morning. Economists forecasting the Fed's preferred inflation gauge to grow in December. Overall PCE expected to come in at 0.3% and core PCE at 0.2% on a month-over-month basis. And then we're going to hear from Fed Governor Michelle Bowman. This is coming after the Fed decision Wednesday pausing its rate cuts. That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.